Investing can be thrilling, can't it? But what happens when excitement turns into despair? Picture Sarah, a beginner investor, who hears all the buzz about a tech company soaring to unprecedented heights. Everyone's talking about it. Could it really be the next big thing? Caught up in the frenzy, she decides to buy in at what she thinks is the peak. But is that a decision she'll soon regret? As the stock continues to climb, Sarah's excitement turns to confidence. She thinks she's hit the jackpot. But here's a twist. What if this momentum is not as solid as it seems? In a moment of sheer enthusiasm, she doubles down, buying even more shares. Is she really making a savvy investment, or just riding a dangerous wave of speculation? Then, just days later, everything changes. The stock starts to plummet. A disappointing earnings report? A sudden regulatory challenge? Panic floods the market as investors begin to sell off, and Sarah can only watch in disbelief. Her investment disappears before her eyes. But what went wrong? Let's talk about timing. Buying at a peak can be a risky game. Did she even consider that a sharp rise might not reflect the company's true value? A pivotal question: how much research did Sarah really do before jumping in? Understanding a company's financial health and market position could have been her lifeline. Now, let's dive into the psychology of investing. Sarah's choice to double down, driven by a fear of missing out, is a trap that ensnares many. Has she fallen victim to the euphoria that blinds so many investors? Instead of sticking to a sound strategy, she gets swept away, convinced she can ride this wave forever. But can anyone truly ride a stock's highs indefinitely? Consider volatility. Stocks like Sarah's can swing wildly, influenced by news or market sentiment. For a beginner, how do you navigate such uncertainty? Sarah overlooked a critical fact. What goes up often comes down just as fast. Did she even account for this risk in her strategy? And then there's diversification. By investing heavily in one stock, Sarah placed her entire future on a single gamble. Isn't it wiser to spread investments across various assets? A diversified portfolio can mitigate losses. Was she aware that different sectors could provide a safety net during turbulent times? Lastly, let's discuss patience and long-term thinking. Investing isn't just a game of quick wins. It's about building wealth over time. Did Sarah understand that markets can be unpredictable? A seasoned investor possesses the discipline to stick to their plan, even amid chaos. Was she prepared for the emotional roller coaster that investing can bring? In the end, Sarah faced a harsh reality. The thrill of investing can easily overshadow the necessity for careful planning. But here's the twist. By grasping these key principles, beginner investors can approach the market with renewed confidence. After all, isn't the goal to not just ride the highs, but to smartly navigate the lows? With patience and knowledge, even the toughest lessons can be invaluable stepping stones for future success. Will Sarah's experience guide her next move? Time will tell.